It was a Thursday in March, 1980. The floor of the commodity exchange in New York was a scene of absolute primal panic. Men in expensive suits were screaming, shoving, and watching their entire net worth evaporate in seconds. They called it Silver Thursday. The price of silver had crashed from nearly $50 down to $10. The Hunt brothers, two Texas oil tycoons who had tried to corner the market, were bankrupt. The establishment had won. The rules were changed in the middle of the night to crush the outsiders and protect the banks. For 40 years, that has been the official story, the cautionary tale. Don't touch silver, they told us. It is a widowmaker. It is a relic. But what if I told you that 1980 was not the end of the story? What if it was just the prologue to a much darker, much more complex mathematical inevitability that is unfolding right now, in real time? We are currently watching the dismantling of a century-old illusion. The price of silver you see on your screen, the ticker tape, the chart, is lying to you. It is a ghost. It is a price derived from paper contracts traded between computers in London and New York, representing metal that largely does not exist. But something has changed. The physical world is waking up. From the solar panel factories in China to the high-tech vaults in Shanghai, the actual metal is disappearing. The shortage is real. And the entities that have suppressed the price for decades, the bullion banks, the exchanges, the paper masters, are currently tapping emergency liquidity facilities to survive. We are standing on the edge of the silver singularity. This isn't just about a price spike. This is about the moment when the paper promise of wealth collides with the hard reality of scarcity. And just like in 1980, they are trying to change the rules to stop it. But this time, the math says they can't. Today, we are going to look at the hidden mechanism of the silver market. We are going to examine the Shanghai disconnect, the export bans, and the quiet panic in the repo markets. We are going to look at why the richest man in the world is suddenly worried about a metal we've been told is worthless. This is the story of the end of the paper age, the hidden mechanism, the paper curtain. To understand the crisis we are in today, you have to understand the architecture of the lie. For the last 40 years, the price of silver has not been determined by how much silver is dug out of the ground or how much is used to build iPhones and Tomahawk missiles. It has been determined by two places, the COMEX in Chicago and the LBMA in London. These are the casinos. In these markets, banks trade futures contracts. A contract is a promise to deliver silver in the future. But here is the secret mechanism. Almost nobody takes delivery. It is a game of musical chairs where the players just trade the receipts back and forth, settling in cash. The system allows for something called hypothecation. It means you can sell the same ounce of silver 100 times. You can print paper silver to infinity. If the price goes too high and the banks are short, they simply print more paper contracts, flood the market, and drive the price down. It is the ultimate suppression tool. It disconnects the price from reality. For decades, this worked. The West controlled the casinos, so the West controlled the price. They could keep silver cheap, which was great for industrial companies and great for the fiat dollar. But every Ponzi scheme has a fatal flaw. It requires that nobody ever asks for their money back all at once. It requires that the physical metal never actually runs out. And that is exactly what is happening right now. The paper curtain is being torn down, not by speculators, but by industry, by physics. The shift, the industrial vacuum. Let's fast forward to the present day. Unlike 1980, silver is no longer just a monetary metal. It isn't just forks and knives and coins buried in a pirate chest. Silver is the most conductive metal in the known universe. It is the best reflector of light. It is antibacterial. You cannot have a modern world without silver. You cannot have a smartphone. You cannot have a 5G tower. You cannot have an electric vehicle. And most importantly, you cannot have the green energy transition. Every solar panel you see on a roof is essentially a silver sandwich. This is where the narrative shifts. While the bankers in London were playing their paper games, the industrial demand for silver began to eat the supply alive. We have been in a structural deficit for years. We are consuming more silver than the miners can dig up. And recently, a voice from the high-tech mountaintop confirmed the fear. Elon Musk. When the richest man in the world, the man building the rockets and the electric cars and the robots, tweets, "This is not good regarding silver shortages," you need to listen. He isn't talking about the price of jewelry. He is talking about the supply chain of the future. He knows that his gigafactories are hungry beasts, and the trough is getting empty. This industrial demand is the floor sticks that didn't exist in 1980. The Hunt brothers could be crushed because nobody needed the silver they held. Today, Apple needs it. Tesla needs it. Raytheon needs it. And this brings us to the villain of our story, or perhaps the catalyst. The sleeping giant that just woke up and locked the doors. China. The catalyst, the Shanghai disconnect. If you want to see the future of the global economy, you don't look at New York anymore. You look at Shanghai. For years, there has been an arbitrage opportunity. The price of silver in Shanghai has been consistently higher than the price in London or New York. We call this the Shanghai premium. Normally, in a free market, this shouldn't exist. Traders would buy cheap silver in London, fly it to Shanghai, sell it for a profit, and the prices would equalize. That is basic economics 101. But the prices aren't equalizing. In fact, the gap is exploding. We are seeing premiums in Shanghai reach $5, $6 over the spot price. Silver is trading at roughly $85 an ounce in China, while the American spot price lags behind. Why? Because the metal isn't moving. The inventory in the West is drying up, and now the hammer has dropped. Reports are flooding in that China is imposing strict export controls on silver effective January 1st. They are requiring special government licenses to let even a single ounce leave the country. Think about the geopolitical chess move here. China dominates the solar panel industry. They control the refining capacity. By locking down the silver supply, they are not just protecting their assets. They are weaponizing the supply chain. They are telling the West, you can keep your paper contracts. You can keep your spot price. We will keep the physical metal. This is the moment the paper price and the physical price divorce. We are seeing a bifurcation of reality. In the West, you have a financial derivative called silver. In the East, you have the strategic element called silver, and the East is willing to pay the real price. The panic cracks in the LBMA. So, what happens when the physical metal stops flowing to London to back up the paper bets? The system breaks. We are receiving signals, quiet, terrified signals, from the London Bullion Market Association, LBMA. This is the heart of the global trading system. Traders are reporting that requests to extend silver leases are being denied. Let me explain what a silver lease is. It's a mechanism banks use to suppress the price and manage their books. They lease silver they don't own to short the market. Usually, when the lease expires, they just roll it over. It's a rubber stamp. Kick the can down the road. But now, the requests are being denied. No more extensions. Pay up. Deliver the metal. This is a margin call on a planetary scale. If the banks cannot extend their leases, they have to go into the open market and buy physical silver to return it. But where do they find it? China has closed the door. The mines are tapped out. The vaults are bleeding. This creates a short squeeze. It forces the banks to bid against each other for the scraps of metal left in the system. And the panic is visible in the banking plumbing. Just recently, we saw banks tapping the Federal Reserve Repo facility for over $17 billion in emergency liquidity. The repo market is the pawn shop for banks. You only go there when you need cash now and nobody else will lend to you. Why do they need $17 billion overnight? Because their short positions are blowing up. They are sitting on billions of dollars of unrealized losses. They bet that silver would go down or stay stable. Instead, it is ripping higher. Every dollar the silver price rises is a knife in the balance sheet of a bullion bank. They are facing a solvency crisis disguised as a liquidity crisis. The counterattack, changing the rules. So the banks are cornered. The metal is gone. The price is rising. What do? Do they admit defeat? Do they let the free market work? Of course not. They do exactly what they did in 1980. They change the rules of the game while the game is being played. The COMEX, the US exchange, has just raised margin requirements on silver. Again, let's explain margin with a simple metaphor. Imagine you want to bet on a horse race. The track tells you that to place a $100 bet, you only need to put down $5 of your own money. That's leverage. It allows speculators to make massive bets with very little cash. Now, imagine the horse you bet on starts winning. Suddenly, the track manager runs out and says, "New rule, to keep that bet open, you now need to put down $20. Right now, in cash." If you don't have the cash, the track cancels your bet. They force you to sell. This creates artificial selling pressure. It forces the longs, the people betting on the price to go up, to exit the market. They just hiked silver margins by over 13%. They hiked platinum by over 20%. This is a desperate defensive measure. It is the financial equivalent of pulling the fire alarm to stop a test you are failing. They are trying to flush out the speculators to cool down the price. But here is the difference between 1980 and today. In 1980, the buyers were speculators. They were using leverage. When the margins were hiked, they went bust. Today, the buyers are industries and sovereign nations. China doesn't buy on margin. Tesla doesn't buy futures contracts on 100x leverage to speculate. They buy physical metal to put in cars. You cannot margin call a solar panel factory. They need the metal regardless of the paper games. So the COMEX can raise margins to 100%. They can make it illegal for Americans to trade futures. It won't matter. Because the price is being set in Shanghai, not Chicago. The center of gravity has shifted. The historical echo. The crime of 1873 to now. This struggle between the productive class, industry, savers, and the financial class, banks, exchanges, is not new. It is the oldest story in modern finance. Go back to the crime of 1873. This was the moment the United States demonetized silver. Before that, silver was the people's money. It was the currency of the farmer, the laborer, the shopkeeper. Gold was the money of the elite, the international settlements, the kings. By destroying silver as money, they concentrated power in the hands of the central banks. They forced the population into a system of paper notes backed by gold, and eventually backed by nothing. We are now living through the reversal of the crime of 1873. We are seeing the failure of fiat currency. When you print trillions of dollars, as the US has done, the money seeks a home. It flows into stocks, it flows into real estate, and finally, when the trust breaks, it flows into hard assets. Look at the chart of total global assets. At the top, you have real estate, a bubble fueled by cheap debt. You have the US dollar, a promise backed by debt. You have Nvidia and tech stocks, valuations based on infinite growth. And then, way down at the bottom, a tiny microscopic sliver of the global pie. You have silver. It is the most undervalued asset on the planet relative to its utility. It is an asset that has intrinsic value, industrial necessity, and monetary history, yet it is priced like it is dirt. This creates a coiled spring. The cup and handle pattern on the 160-year chart isn't just lines on a screen. It is a visual representation of energy accumulation. For a century and a half, the price has been compressed, and now the lid is blowing off. The warning. The deliveries that won't happen. We are heading into a December and January that could redefine the market. The COMEX has issued delivery notices for over 63 million ounces of silver for December. That is a record high. That means the people holding the paper contracts are standing up and saying, okay, I don't want the cash anymore. Send me the bars. 63 million ounces. Does the COMEX have 63 million ounces of registered silver ready to move? The official numbers say, maybe, but the insiders know the truth. Much of that silver is eligible but not registered. It belongs to private owners who might not want to sell at these prices. If those delivery demands are not met, the exchange has a force majeure clause. They can legally say, we cannot deliver the metal. Here's a check for the cash equivalent instead. That sounds like a solution, but it is actually the death knell of the market. If the COMEX forces cash settlement, they are admitting they are no longer a silver market. They are just a betting shop. The moment that happens, the trust evaporates. Any serious player who wants metal will leave New York and go directly to the miners or to Shanghai. The price in New York will become irrelevant. It will be a zombie number. The real price, the price you have to pay to actually hold a bar in your hand, will detach and skyrocket. We are already seeing this. If you try to buy a Silver Eagle or a bar online today, look at the premium. The spot price might say $79, but you are paying $85, $90, maybe $100. That premium is the real market screaming that the paper price is fake. The future, a world without silver? So, what does the next 6 months look like? We are likely to see extreme volatility. The banks are powerful. They will use every trick, every margin hike, every media narrative to smash the price down. They might succeed in the short term. They might trigger a flash crash. But they are fighting gravity. They are fighting a China that wants to corner the green energy market. They are fighting a depleting geological resource. They are fighting a loss of faith in the US dollar. We are moving toward a world of resource nationalism. Countries that have the stuff, the oil, the lithium, the copper, the silver, are starting to realize that they hold the cards. They are tired of trading their real resources for depreciating Western paper. The export bans we see in China are just the beginning. Mexico could be next. Peru could be next. If the nations that mine the silver decide to nationalize it or hoard it, the global supply chain freezes. This is the silver singularity. It is the point where the supply curve goes vertical. If you are holding silver, you are not just holding a metal. You are holding a vote against the current system. You are holding a piece of the physical reality that cannot be printed, cannot be leased, and cannot be rehypothecated into oblivion. The panic on the repo market, the breaking of the LBMA, the silence of the mainstream media followed by the sudden noise from Forbes and Musk, these are all symptoms of the same disease. The disease is leverage. The disease is the belief that we can financialize nature. Nature is calling the bluff. The wealth transfer we are about to witness will not be from the poor to the rich. It will be from the paper holders to the physical holders. History shows us that all fiat currencies eventually return to their intrinsic value, zero. Gold and silver have survived every empire, every war, and every central bank in human history. The paper game is ending. The physical squeeze has begun. So when you see the price dip, or you see the margin hikes, or you hear the experts say, it's a bubble, remember 1980. Remember the Hunt brothers. But then remember that this time it isn't two cowboys from Texas. It is the industrial infrastructure of the 21st century, and they can't print silver. Do not be distracted by the noise. Watch the vaults, watch Shanghai, watch the physical inventories. The math is inevitable. Thank you for watching. If you want to understand the history of financial collapse so you can prepare for the future, make sure you are subscribed. I'll see you in the next one.